Today, we're diving into the essential world of financial statements, a cornerstone for understanding any business. These statements are crucial tools that help us truly understand a company's financial health and performance. There are four core financial statements that every business uses to report its financial activities. Think of them as vital snapshots and summaries, offering different perspectives on a company's financial story. First, let's look at the income statement, often called the profit and loss statement. It summarizes a company's revenues, expenses, and profits over a specific accounting period. This statement clearly shows how profitable a company has been during that period. Next, we have the balance sheet, which provides a financial picture at a single point in time. It presents a company's assets, liabilities, and equity at a specific moment. The balance sheet reveals a company's financial position and its overall stability. Then, there's the cash flow statement, crucial for understanding cash movements. It tracks cash inflows and outflows from operations, investing, and financing activities. This statement is absolutely essential for assessing a company's liquidity and solvency. Finally, we examine the equity statement, focusing on ownership changes. It details all changes in shareholders' equity over a defined accounting period. This statement explains how the company's ownership value has changed over time. Let's now focus on the specific purpose of the income statement in financial reporting. It offers key insights into a company's financial performance, showing how well it's doing. One primary purpose is performance evaluation, assessing how the company has performed financially. It measures the company's financial performance over a specific accounting period, like a quarter or year. Another key purpose is profitability analysis, understanding how much profit a company generates. It determines profitability by comparing the company's revenues against its expenses. Finally, the income statement is vital for effective decision-making by various stakeholders. It helps stakeholders make informed decisions regarding investments, lending, and overall management strategies. Now, let's explore the flow of the income statement, step by step from top to bottom. We'll trace how we move from initial revenue all the way down to a company's net income. It starts with net revenue, which is the total income after returns and discounts. For example, if sales are 1 lakh rupees and returns are 5,000, net revenue is 95,000 rupees. Next, we calculate the cost of goods sold, or COGS, the direct costs of production. If opening inventory is 20,000, purchases 50,000, and closing 10,000, COGS is 60,000 rupees. Subtracting COGS from net revenue gives us the gross profit. So, with 95,000 net revenue and 60,000 COGS, gross profit is 35,000 rupees. From gross profit, we subtract operating expenses to arrive at operating income. If gross profit is 35,000 and operating expenses 20,000, operating income is 15,000 rupees. Finally, after all expenses and taxes, we reach the company's net income. If income before tax is 14,500 and tax is 4,350, net income is 10,150 rupees. Let's explore some key ratios derived from the income statement, which are powerful analytical tools. These ratios are essential for effectively measuring and evaluating a company's financial performance. First, we have profitability margins, which indicate how much profit a company makes. Gross profit margin measures the percentage of revenue remaining after covering the cost of goods sold. Operating profit margin shows the percentage of revenue left after deducting all operating expenses. Next, we consider ratios that gauge a company's overall efficiency in generating profits. Net profit margin reveals the percentage of revenue that remains as profit after all expenses and taxes. Now, let's turn our attention to the crucial purpose of the balance sheet. The balance sheet provides a snapshot of a company's financial position, detailing assets, liabilities, and equity at a specific point in time. Let's dive into the balance sheet structure, a fundamental financial statement that provides a snapshot of a company's financial health. Here, we'll see how assets, liabilities, and equity are always in balance, forming the core accounting equation. First, let's explore assets, which are what the company owns and expects to provide future economic benefits. Current assets are easily converted to cash or used within 1 year, like the cash you have or your inventory. Non-current assets, conversely, provide benefits for more than 1 year, such as property, plant, and equipment. Next, we have liabilities, which represent what the company owes to external parties or creditors. Current liabilities are obligations due within 1 year, like accounts payable or short-term loans that need to be settled soon. Non-current liabilities are obligations due beyond 1 year, such as long-term loans or bonds payable over many years. Finally, we arrive at equity, which represents the owner's residual claim on the company's assets. Owner's equity is the residual interest in assets after liabilities, including common stock and the company's retained earnings. Now, let's understand the vital purpose of the cash flow statement, a crucial tool for financial analysis. This statement tracks cash inflows and outflows, showing how cash is generated and used across operations, investing, and financing. It assesses liquidity. Let's break down the 3 main categories of activities that comprise the cash flow statement. We'll see how these activities radiate from the core, giving a complete picture of cash movements. First, operating activities, which involve the cash flows from the company's primary revenue-generating business. These are the cash flows directly linked to the core business, generating revenue and incurring expenses. Next, investing activities, which deal with cash flows from buying or selling long-term assets. This includes cash spent on acquiring or received from disposing of long-term assets like property and equipment. Finally, financing activities cover cash flows related to obtaining or repaying capital from owners and creditors. These are cash movements from debt, equity, and dividends, impacting the capital structure of the company. Now, let's examine the statement of changes in equity, which tracks the movement of ownership value. This statement is crucial for tracking shifts in the ownership value within a company over a period. We begin with the opening balance, representing the total equity at the start of the reporting period. For instance, let's say our opening equity balance was 41,000 rupees at the period's beginning. Next, net income, which is the profit or loss for the period, directly impacting retained earnings. If the net income is 10,150 rupees, it's added to or subtracted from retained earnings. Then, dividends paid, which are amounts distributed to shareholders, reducing the company's retained earnings. For example, if 1,000 rupees in dividends were paid, this amount reduces the retained earnings. Capital changes reflect the impact of issuing new shares or repurchasing existing shares in the market. Issuing new shares adds 3,000 rupees, while repurchasing shares subtracts 2,000, affecting equity. Finally, the closing balance is the total equity at the end of the period, reflecting all these changes. The final balance, for instance, 51,650 rupees, is calculated by summing all these changes. To wrap things up, let's review the key takeaways from our discussion on financial statements. These are the essential points you should remember to understand a company's financial health effectively. Remember, financial statements are vital for gaining crucial insights into a company's overall financial health. The income statement specifically reveals a company's profitability and financial performance over a period. The balance sheet gives a snapshot of assets, liabilities, and equity at a very specific point in time. The cash flow statement meticulously tracks all cash movements from operating, investing, and financing activities. And the statement of changes in equity details all shifts in shareholders' ownership value over time. Analyzing these statements together helps evaluate performance and make well-informed, strategic business decisions.